Hello everyone, welcome back. In this lesson, we're going to learn how to set up the Perp versus Perp funding rate arbitrage strategy. Sometimes I also call it futures arbitrage, but don't worry. In crypto, the terms perpetual and futures are pretty much interchangeable. In this lesson, we'll simply call them perps. The setup for this strategy is actually very similar to what you learned in the previous lesson. We still need two exchanges, and we still need to create a delta neutral structure. But instead of using spot on one side and perpetual on the other, this time we will open two perpetual positions. A long position on one exchange and a short position on the other exchange with the exact same position size. Just like before, we also need to prepare proper stop loss and take profit settings on both sides. This is important to avoid liquidation and to make sure both positions close safely at the same time. In my opinion, this method is much easier and significantly better than the spot versus perpetual arbitrage you learned earlier. The biggest advantage is the much higher efficiency of capital, which leads to a much higher ROI. From our earlier calculations, a good perp versus perp setup can easily reach over 30% annual return, sometimes even more. However, this strategy also has one disadvantage. You have fewer choices. To execute this properly, you need to find a coin that offers a strong, positive net funding rate between the two exchanges you are using. And if you want to stay on non-KYC exchanges only, the number of available pairs becomes even smaller. But once you find a good pair, this strategy is simpler to run, requires less capital, and gives you a much better return than spot versus perp arbitrage. All right? In the next steps, I'll show you exactly how to set it up. First, make sure you have almost the same amount of USDT in the futures accounts of both exchanges. For example, in this demonstration, I have 650 USDT on each side. This keeps your position size balanced. For today's demonstration, I'm choosing a coin called AVAX for our arbitrage setup. The reason is simple. AVAX consistently shows a positive net funding rate between the two exchanges. I personally like coins that have stable, repeating patterns, one side staying positive and the other staying negative, because it greatly increases the chance that the net funding rate will continue to be positive in the future. After checking the transaction fees, I decided that I will place the limit order on MEXC first. On MEXC, the maker fee is 0.01%. Then, once that order is filled, I'll place another limit order on Bitunix, try to get the maker fee, where the fee is 0.02%. So the total cost of opening this arbitrage position is only 0.03%, which I hope that it can be covered by two funding cycle. That's 16 hours. Next, I go to my ROI calculation sheet. I input the funding rates from both exchanges, and the spreadsheet shows that the annual ROI at 6 times leverage is about 52%. If I increase the leverage to 7 times, the ROI jumps to around 61%. However, in this setup, I prefer to stay at 6 times leverage. I do not want the liquidation price to be too close. In a future lesson, I'm going to teach you how to adjust your margin properly so that your position remains safe even during price swings. All right, let's begin the actual setup. Go to MEXC, select the coin AVAX, set your margin mode to isolated, and choose 6 times leverage for the open short position. Click on limit order and click last to capture the latest traded price. Because we are opening a long position, make sure you are reading the green bidding price queue. If the market is moving slowly, simply place your limit order somewhere in the middle of the green queue. That ensures you enter as a maker and enjoy the lower fee. Now, choose cost value. This part is important. In the spot versus perp strategy, we use the quantity of the coin to match the position size. But in the perp versus perp arbitrage, we don't care about quantity at all. We care only about the cost value, meaning how much USDT you are putting into the position multiplied by your leverage. So both exchanges must use the same cost amount. Next, switch over to Bitunix to prepare your limit order. Select the same coin, set isolated margin mode, and use the same 6 times leverage. For the futures unit mode, switch to order by cost USDT. Then input the exact same cost amount that you used on MEXC. When you're ready, go back to MEXC and double check your limit order price. Make sure the price is still somewhere in the middle of the green bidding price queue. If the market has moved away, adjust the limit order so it stays close to the live price, but never too close. If you enter the exact trading price, your order may be executed as a taker and you will pay extra fees. Always let the market come to your price. You can see that after the order has been submitted, it appears under the Open Orders tab. But now the price is rising quickly, moving further and further away from your limit price. If you want your order to be executed sooner, I suggest modifying your limit order price so that it moves closer to the current market price. Again, please do not enter the exact market price that will trigger a taker execution and you'll be charged a higher fee. Instead, keep your price a few ticks away from the live market price. Stay focused on the order, keep your eye on the queue, and wait for the moment when the market comes back to meet your limit price. When your order is finally executed on MEXC, immediately return to Bitunix and click the Submit button on your pending limit short order. At this moment, there are 2 possible outcomes, depending on the market price at that moment. You know, the crypto price can move very quickly in a few seconds. If your limit price is lower than or equal to the current market price, the exchange will treat your order as a market order. It will execute instantly and you will be charged the taker fee. But if your limit price is higher than the current market price, then your order will enter the queue and be executed as a maker, which means you enjoy the lower maker fee, which is good. This method is a little more advanced compared to the spot versus perp arbitrage strategy, where I usually rely only on market orders on one side. In the perp versus perp strategy, sometimes you get the benefit of the lower maker fee, and sometimes you will still end up paying the taker fee, and that's completely normal. You can start using this advanced method once you've gained more experience and feel comfortable adjusting your limit orders. Once this final step is done, your long and short positions are both open, and you now have a fully established delta neutral perp versus perp arbitrage position. Just like I explained in the previous lesson, you now need to check whether your arbitrage position is set up correctly. Look at the unrealized profit and loss on both exchanges. The numbers should offset each other. If one exchange is showing a small gain, the other should show a small loss in roughly the same magnitude. If they do not offset, for example, if one side is much larger than the other, you likely made a mistake. Common mistakes include using the wrong leverage, choosing the wrong margin mode, or accidentally using cross margin instead of isolated. If anything looks wrong, it is always safer to close both trades and start again. Once everything is balanced, your arbitrage position is ready. And from that point on, you simply earn funding, funding, and more funding. But before you walk away, there is one more very important step. You must set up the take profit and stop loss on both exchanges. Remember, our goal is simple. Avoid liquidation at all costs. On the long side, your position gets liquidated when the price drops all the way down to the estimated liquidation price. On the short side, your position gets liquidated when the price rises up to the estimated liquidation price. And because the crypto market is highly volatile, prices can spike up or down very quickly. We must always set our take profit and stop loss levels immediately after the arbitrage position is created. Don't wait, don't delay, do it right away. Here is the rule of thumb. For the long side, set your stop loss about 0.5% above the liquidation price. For the short side, set your stop loss about 0.5% below the liquidation price. This small buffer helps protect you against sudden price spikes that can hit the liquidation level unexpectedly. Now, to make both positions close at the same time, you must link the exit points together. That means the stop loss on one exchange becomes the take profit price on the other exchange. So when one side stops out, the other side exits automatically, keeping the entire arbitrage structure safe and clean. Once you've set the stop loss and take profit on both exchanges, that's it. Your work is done. Your position is protected. Your liquidation risk is minimized. And from this point onward, you'll simply earn funding rate income cycle after cycle, unless the stop loss has been triggered. Now that you've learned the detailed and practical steps for setting up the Perp versus Perp arbitrage strategy, you might be thinking about something very important. If the net funding rate is positive and working in my favor, of course, I'd love to enjoy that funding income for as long as possible. But in reality, when the price moves up or down and eventually hits my stop loss, the position closes and I need to set everything up again. That means more fees, more effort, and more time. So the big question is, how can I enjoy the funding rate for a longer period of time without constantly being stopped out? And yes, there is an answer. There are specific techniques, smart timing, and practical methods that allow you to hold your arbitrage position safely for a much longer period while still protecting yourself from liquidation. In the next lesson, I'm going to teach you the right timing to enter an arbitrage position, how to maintain your arbitrage for as long as you want, and several practical tips that experienced traders use to maximize funding income while keeping risk low. So get ready. The next lesson will help you level up your strategy and make the whole process much smoother and more profitable.